Morning students, welcome back to the session on audit. So today we'll continue with another account or auditing standard. We have been discussing about auditing standards which require certain considerations from the auditor's perspective. So another one in this series is SA 510, which deals with initial audit engagements and in respect of opening balances, what should be the considerations on the part of the auditor. Again, a very important standard, and I would say an auditing standard on which there's a practical perspective which is currently not really looked at. So in terms of this auditing standard, generally some of these things are ignored by the auditors. This is what is observed in case of the engagements that we see practically. Yeah, and we'll also try to understand as to what could be the challenges in relation to some of these things. So let us first of all understand about these initial audit engagements. What do you mean by them? Initial audit engagements and the opening balances means what is it in terms of the audit engagements, or what are the areas of audit which are covered by this auditing standard. So this is an engagement. Initial audit engagement means it's an engagement in which either the financial statements for the prior period were not audited. This is the first scenario. Or the financial statements for the prior period were audited by a predecessor auditor. Means the auditor in the last year, in the previous year, was a different one. And that's why we have a new auditor now in the current year. Let's try to understand about the opening balances. So these are the account balances that exist at the beginning of the period. Opening balances are based upon closing balances of the prior period and reflect the effect of transactions and events of prior periods and accounting policies applied in the prior period. Opening balances also include matters requiring disclosures that existed at the beginning of the period, such as contingencies and commitments. Third, predecessor auditor. That means the previous auditor. The auditor from a different audit firm who audited the financial statements of an entity in the prior period and who has been currently replaced by the current auditor. And now what we can do is we can just look at this situation with the help of one example. How should this situation really look like? So talking about SA 510, let's suppose we are discussing about two periods. So this is 2019-20 and this is 2020-21. Okay, so we have got two financial years. For this financial year, audit is already completed, and the audit was completed by ABC and Company LLP. Okay, so this firm was the auditor for this financial year, and the audit is completed. This audit is completed. And we are moving on to 1st April 2020. This is 31st March 2021. Okay, yeah. Now, when it comes to the predecessor auditor, who is the predecessor auditor? ABC and Company LLP will be called as predecessor auditor or previous auditor. Now, for the current year, this is the current year. This is current year. For the current year, company has changed its auditor. So a new auditor has come in. let's suppose it's Ram and Company. So now the new auditor is Ram and Company. Again, it's a firm. It's a firm, and this firm will have auditors. Now these auditors are called as current auditors. Now for our purposes, the audit engagement is which one? Audit engagement is for the period 2020-21. So when it comes to audit engagement, this would be 2020-21. Means this is the year under audit, because for this year audit is already completed. Secondly, when we close the financial statements, so the closing balances of the balance sheet will move on to the next year. Closing balances of the balance sheet will move on to the next year, and they will become the opening balances. So they will become opening balances. Okay. Now these opening balances are what? They are nothing but the closing balances as of 31st March 2020. Now, if we look at the financial year 2019-20, it is already audited. And that's why if we look at the opening balances, that means 1st April 2020, those are also in a way audited because the same numbers are carried forward. Now, if we look at this new auditor will be required to issue his audit report in respect of complete financial year. So he will be responsible for full 2020-21, correct? Which would also include these opening balances, because 2020-21, the numbers which will go into this year, they will also have the opening balances. So if the opening balances are coming in, so if we have the opening balances which are coming in the current year, so that means in respect of these opening balances, some procedures or some audit procedures, we can say, may or may not be required to be performed by this new auditor. Now, this is what this auditing standard deals with. This auditing standard helps us to understand. This auditing standard helps us to have this guidance around the audit procedures to be performed on these opening balances and whether to perform any audit procedures on these opening balances. Okay, clear on this? Clear on the understanding about the previous auditor and the new auditor? What is this audit engagement that we have been looking at? What are the opening balances which are under discussion? This auditing standard doesn't talk about the audit procedures to be performed in relation to the this period which is other than the one that is on the opening date. So it's all about opening balances which has been covered over here. Yeah. Now a question may arise that if the opening balances have already been audited, why are we saying that is already audited? Because the closing balances were audited. So if the closing balances were audited and those are moved forward, then what's the need for audit of opening balances? That's why a question may arise that do we really need to carry out any procedure on the opening balances? Or can we not say in the audit report, or can the company not say somewhere in the financial statements that the opening balances were already audited? Those are already audited. Those were audited by the by this audit firm ABC and Company LLP. And can Ram and Company report in his auditor's report that these opening balances will not be audited by him because these are already audited? Or can Ram and Company be will have this option of taking the cushion of not performing any audit procedure on the opening balances. Now, because Ram and Company has now become the auditor, and because he will be expressing an opinion in relation to this financial year, that's why even if these opening balances were in a way audited by the predecessor auditor, still Ram and Company would be held responsible for any of the transactions, for any of the balances which move forward in relation to these opening balances also. So that means to perform audit procedures on the opening balances becomes the responsibility of Ram and Company. And this is not something which we can say is a duplication, because some of you may have a query that will this not be a duplication, because if the procedures are already performed, then what's the need to go in for those procedures once again? Even if the procedures are performed, and let's suppose even if the predecessor auditors would have continued, they would have also performed certain procedures on this. Let's try to understand what procedures would have been performed if ABC and Company LLP would have continued with the audit. So I think the first and very, very common procedure which is known to all of us will be about ensuring opening balances tied to closing balances of last year. So whenever an auditor starts the audit, auditor would always check. Auditor would always tick the opening balances with the final balances of the last year, means the closing balances of the last year. Always. Why? Because that becomes the basis. And that is important on the part of the auditor to make sure whether the same closing balances have been moved forward or not. If that is not done, then it will lead to an error. Yeah. So even if this auditor would have continued, this procedure would have been performed by him. Okay. And that's why this procedure will also be required to be performed by our Ram and Company. So Ram and Company will also have no option in respect of leaving this procedure. Yeah. So this procedure is something which is common to both of them. So both of them will have to perform these audit procedures. So this is number one. Number two, it may happen that now because a new auditor has come, company changes its accounting policies. Let's suppose in the last year, there was some accounting policy and now that has been changed. Why? Because the company is thinking that it's a new auditor who has come in, and that's why it's okay to change the accounting policy, which again may not be appropriate. Because the new auditor has come in, so that's why company cannot, that cannot be the reason of changing the accounting policy. Accounting policies are driven by the accounting standards, which require consistency of accounting policies, except in certain situations wherein the accounting standards allow the changes. Okay. Now, as regards the accounting policies, now it therefore becomes important on the part of this new auditor to ensure that accounting policies are consistent. So next point which the new auditor will have to consider would be the consistency of accounting policies. This is the second procedure, and this is again a very, very important procedure on the part of the new auditor. If there are any changes in the accounting policies, except for the reasons which are permitted by the accounting standards and which also need to be analyzed by the auditor. Auditor means the new auditor. Yeah. If there are any such changes, then the auditor will have to get those amended in the financial statements. Just because the auditor has changed cannot become the reason for the changes in the accounting policies. Okay. And this is something which previous auditor would also have ensured. So actually, if you look at both of these procedures, these are not something which only the new auditor will have to do. Anyways, the previous auditor would have also performed these audit procedures. So we can say these two audit procedures are similar. Let's move on to third audit procedure, which the standard also specifies in respect of audit of such type of opening balances. And in respect of third procedure, if you can look at the screen, standard says perform one or more of the following. Means along with these two, one or more of these procedures will have to be performed. So let's understand what are these procedures. Where the prior year financial statements were audited. So in our scenario, prior year financial statements were audited. When using the copies of audited financial statements, including other relevant documents relating to prior period financial statements, evaluating whether audit procedures performed in the current period provide evidence relevant to the opening balances, or performing specific audit procedures to obtain evidence regarding the opening balances. So let's try to understand this procedure or this third part of the procedures which is recommended by this, which is covered in this auditing standard. It says that in respect of these opening balances, other than these two procedures, auditor would also perform some audit procedures, or we can say some more audit procedures, to ensure that the balances which would appear as at 31st March 2021 out of these opening balances, they reflect true and fair view. Yeah. So let's understand how would that be possible. And we need to take some examples to understand about all of these things. And we can look at certain areas and try to understand with the help of those areas, how can the new auditor really audit any of these opening balances. And we'll also try to differentiate if the auditor would have continued, means if the previous auditor would have stayed, then how that audit procedure may not have been really relevant on the spot. Okay, so number one. So we have new auditor now, Ram and company. Number one, let's suppose opening balances include land, which amounts to rupees 1 crore. Okay. Now, in respect of land, let's go, there's no change. And land is again not something which is subject to depreciation. So this balance would have continued. And let's suppose this balance also continues on this date. And this has been carried forward. If the previous auditor would have continued, what would he do? He would look at his previous year's working papers and just roll forward those working papers to the current year. Because the title deed of the land, any of the any of the areas which may impact the rights of the company towards this land would have already been verified by the previous auditor. So he would have just rolled forward those audit procedures or the working papers for his records. But now, for the new auditor, it's something which is not known to him, except what he sees in the financial statements. He has not really looked at any of the working papers of the previous auditor. So that's why what would now be required on the part of the new auditor, because this is moving into the closing balances. So we need to verify the documents in relation to land. Even though this was already audited, still the new auditor would need to verify the documents in relation to land. So it's like testing of this land afresh. Number one. Number two, it could be about debtors now. Let's suppose opening balances of debtors was rupees 15 crore. And at the year end, closing balances of debtor is rupees, let's say, 5 crore. Okay. Now, various situations are possible for these debtors. First option, that all of these 15 crore debtors have been collected during the year. They have been collected during the year, and these balances represent the balances in respect of sales of the current year. First option. If this scenario exists, then there is no risk on the part of the new auditor as regards the opening balances are concerned. Why? Because those are fully settled, those are fully recovered, and this is something which would have also got test checked by the new auditor in terms of his audit procedures. And this is something which is already collected. Another scenario which is possible could be that out of these 15 crore, 2 crore is still outstanding. Means this 5 crore comprises of 2 crore of the opening balances and 3 crore which is generated due to current year sales. This is the second scenario. Now in this case, the new auditor is carrying the opening balance as at 31st March 2021. Now, if he would carry the opening balances in such a scenario, for this new sales or the sales of the current year, auditor would have performed some procedures. Obviously, yeah. So that means we can say that for this 3 crore, auditor would have performed procedures, maybe in the sales testing or maybe in relation to any other area through which this debtor would have got generated equivalent to 3 crore. But as regards this 2 crore, nothing is known to the new auditor because he has not done any sales testing of the previous years. So that's why he doesn't know about this 2 crore. Means how did the sales occur, about this accuracy of this 2 crore. So various assertions which are related to these 2 crores is not something which is known to the new auditor. So that's why in this case, when the new auditor would select the samples, he would also be required to consider this population separately and ensure that this population of debtors equivalent to 2 crore is also tested by him. Okay, the testing by the new auditor would again be on a sample basis. So it's not something which will require the testing on 100% basis. That's not the requirement, and that's not really the intent. Testing would again be based on the judgment of the auditor and on a sample basis. But whenever this 2 crore will be there, this will require certain procedures on the part of the auditor. Okay. Another example which we can pick up could be related to other items of PPE. So we can look at other items of PPE. That means PPE other than land. So this was 1, this was 2, this was 3. PPE other than land. Let's suppose company had plant and machinery. Now, in respect of opening balances, no procedure was performed by the auditor on that plant and machinery. But because that plant and machinery would continue to appear as at 31st March 2021, so one was procedure which the new auditor would perform on this plant and machinery would be to compute depreciation or to recompute depreciation, to check depreciation. But that is only one aspect related to PPE, which would get tested as at the year end. But as regards the existence, as regards the verification, accuracy of this plant and machinery, nothing is known to the new auditor. Yeah, so that's why it will be important on the part of the new auditor to ensure that the balances get tested over here and with some samples selected out of those plant and machinery items which belong to the last year. Because for the current year, additions testing would be done, but for the opening balances, nothing would be done. So that would be required to be performed on the part of the auditor. Okay, clear on this? Yeah. This is about some of the additional audit procedures which the new auditor would require in respect of opening balances. Now, at times, it may happen that in respect of opening balances, which he would verify, some misstatements are identified. Now, in such a situation, a question arises that how would those misstatements be dealt with? So let's try to understand about those misstatements, or what will be the action plan of the new auditor in respect of those. Let's suppose in the current year, auditor finds some misstatements. Misstatement means, as we discussed, errors, which could be intentional or unintentional. Let's suppose misstatements have been identified. Now, in relation to these misstatements, which the new auditor would identify, first of all, the auditor would analyze whether those misstatements are material or not. This is the first thing. Because depending on the materiality, their adjustment would be required. Along with this assessment of materiality, auditor would also want to understand from the management the reason for those misstatements. So that means auditor would have discussions with the management and may also require discussions with those charged with governance in respect of certain misstatements which could be material, or in respect of certain misstatements which may be of significant importance to the auditor or to the overall set of the financial statements, which will have to be analyzed by the auditor. Now, in case there are misstatements which are material, then the auditor would need to get those corrected in the financial statements, and their corrections in the financial statements would be dependent on the accounting requirements. So that means if the accounting standards require restatement of the financial statements, then those would be restated. If the financial statements don't require restatement of the financial statements, then no such restatement would happen. So as around the changes which would be made in the financial statement, that will be all based on the accounting standard. So we are not getting into the accounting standard. We're just saying that accounting of these misstatements would be as per the financial reporting framework. For the purposes of auditor, some of the important things which would then become relevant would be to consider whether he would want to increase his audit procedures, considering the misstatements he may have identified in relation to the opening balances. Because if there are misstatements, then he may want to increase his sample size. He may want to perform some additional audit procedures because his overall comfort in respect of the opening balances may go down. So that is another area which the auditor will have to analyze and accordingly perform some additional procedures which appear to be right on the part of the auditor. Secondly, he would have discussions with the management to understand the reasons for the misstatements, and if the misstatements are material, then definitely get those corrected in the financial statements. Okay. Another situation which is possible could be related to some modifications. Okay, and now we are talking about last year, this year. Now, two situations are what we need to discuss. First situation is that in respect of the opening balances, auditor found some problems, and because those were not adjusted in the financial statements of the last year, auditor, that means the new auditor, may have a view that last year's financial statement should have been modified, but those were not modified. Means those should have been modified, but those were not modified. Modified opinion should have been given by the previous auditor, but previous auditor didn't issue any modified opinion. Opinion was all clean. In such a case, new auditor will have to consider the reporting implications for the current year in line with the action plan taken by the management, in line with the adjustments, if any, which those misstatements would require, irrespective of whether the opinion of the last year was clean or not. Okay, number one. Number two, situation number two, which is possible, is that in the last year, previous auditor issued modified opinion. Okay, and the modified opinion relates to the opening balances, which are now carried forward. Now, what would this new auditor do, considering the fact that last year's audit report was modified? Now, here again, the new auditor would require his independent assessment. See, in simple terms, instead of just getting into various situations and trying to create various cases, you can just very simply understand that irrespective of whatever was performed in the last year by the previous auditor, whether he issued a modified report which should have been issued, or whether he whether he issued modified opinion which should not have been modified, or whether he issued clean report which should have been modified. Irrespective of that, new auditor would require independent assessment. Independent assessment means he should not look at the modification. He should evaluate about any of these situations on his own. Means as per his view, should this modification be given, or what was the view of the new auditor? Means if the new auditor was in place of the old auditor, would he have considered this modification or not? If the new auditor believes that the modified opinion given in the last year was not correct, means modified opinion should not have been given, the report should have been clean, then in respect of current year, he may remove that modification. And if the new auditor believes that last year's report should have been modified, but which was not done, then in the current year, he will have to consider the implications of those misstatements which could be there in the opening balances, on the closing balances, and on the current year's financial statements. If there are material misstatements due to these opening balances which are carried forward and which are not adjusted, then the new auditor may want to qualify or may want to modify the report of the current year. But that is only possible when there will be a misstatement which is material, otherwise not. And what's the basis of checking whether the misstatement is material or not? It's the same thing, materiality. And this materiality would again be required to be assessed by the new auditor. This will not be the materiality of the previous auditor. It's all independent. So in a way, we are saying that it's all complete independent assessment which the new auditor is doing. And if the new auditor is okay with that, if the new auditor is completely fine in terms of the assessment, and he's fine that there's no need for giving any modified opinion, then he may just remove any of the modifications also. Okay. At times, it may also be possible that last year, in terms of the modification, EOM was given. EOM is emphasis of matter. This is not really a modification though. You can say it's sort of a highlighting of certain matters which is done in the audit report, and we'll understand about all of these modifications in more detail as we move forward. For the time being, we're just looking at few situations wherein, let's suppose, a kind of opinion was issued with which carried emphasis of matter, and which the new auditor believes should have a qualification instead of this emphasis of matter. Then here again, new auditor will not change anything related to the previous year. He will not change this audit report. What will now be considered by the new auditor? Very simply, whether any of these things will have any implications in the current financial year. Okay. And along with this, one point which cannot be ignored over here and which is very, very critical, that even though it's the current financial year for which the new auditor is appointed, still the comparatives, okay, these were with the comparatives. The numbers of the financial year 1920 would be the comparatives. The comparatives should also not be misstated, because if the comparatives would be misstated, then those may also lead to modifications in the auditor's report by the new auditor. So that means it's not only the current financial year which the auditor needs to take care, he also needs to look at the comparatives, which will be forming part of the financial statements, and those comparatives cannot be ignored by the new auditor, and the management will have to consider all of these situations. Okay, clear on this? Now we can look at one example and we can just try to create a sort of case scenario and try to see how that situation would be dealt by the auditor. Say during the course of the audit of financial year 2019-20, new auditor is appointed. So there is new auditor over here. Okay. And this new auditor wants to perform certain procedures on the opening balances. Opening balances as at 1st April 2019. Yeah. So this is what new auditor wants to do. Secondly, in respect of current year, now the current year is 2019-20, there are few procedures which would be common in terms of testing of certain areas which will also be covering opening balances. Okay, for example, sales testing. For example, purchases testing, and which would be related to bank balances, and the fourth one could be related to inventory balances. All right. Now the new auditor wants to perform testing of balances of bank as well as inventory as at 1st April 2019. Okay. But the management is of the view that these balances would also get tested by the auditor when he would perform his procedures for the balances of these two as at 31st March 2020. So management is of the view that these balances or these two balances would anyways get tested by the new auditor when he would be testing both these items as at 31st March 2020. Okay. For these two, it's absolutely not a problem, because these two are more in the context of current year, that means 1920, except for certain items which belong to the opening balances, for which sales testing and purchases testing has also been picked up by the new auditor. So he is looking at testing of sales, he is looking at testing of purchases in respect of debtors and in respect of creditors which are appearing in this opening balance. So the fact pattern is clear to all of you? Yeah. Now in this case, let's try to understand with the reference of this SA 510, what would be what would be or whether these four items which have been picked up by the auditor would be okay, and if let's suppose there's any disconnect of the auditor with the management, how can that scenario be dealt with? So we can look at certain situations now. So the first situation is that I'll just number this up. 1, 2, 3, 4. So the first situation is that auditor should perform procedures for all of these four. So 1, 2, 4, if the auditor requires, is completely okay. There is absolutely no problem, and this should be done. If there is any problem in this, then it may lead to limitation of procedures on the part of the auditor, and which may have reporting implications. Number one, option number one. Option number two. Option number two says that as regards 1 and 2, this seems to be okay, but as regards 3 and 4, this doesn't seem to be okay because this appears to be more of duplication. So that's why this should be avoided by the auditor. Yeah. Another option. Option number C says 1 and 2 don't appear to be fine because actually auditor is going back to previous years by looking at sales and purchases of the previous years, which is of no use because it's all done. It's all appearing in the form of balances, and which would actually get tested when these balances would get tested at the end of 31st March 2020. But to perform procedure number 3 and 4 is all right. So that appears to be fine. That is absolutely okay. And option number D is that as regards all of these four items which have been picked up, or all of these four procedures which have been picked up, auditor should first of all look at previous year's financial statements. Auditor should look at the audit report of the previous year. If everything is okay, then auditor should look at a couple of things. One, should have discussions, inquiries with the management, should have discussion, inquiries number one. And secondly, other than this discussion or inquiry, if there is anything that the auditor wants to consider out of these four, he may have a communication with those charged with governance. If the audit report in the previous year was clean, and which is a fact. So in the previous year, audit report was clean. Now we need to check that out of these four options, which option would be correct in the given scenario. So I would also suggest if you can just start sharing your options and along with the reason as to why you would opt that particular option. Okay, yeah. And now we'll go from option number D to option number A. So first of all, we can pick up option number D and we can just try to analyze it, whether this appears to be all right. Option number D is actually limiting the audit procedures to discussions and inquiries and the communications. And this requires auditors' procedures to be dependent on whether the last year's audit report was clean or not. And there is no such provision in the auditing standard. Audit procedures are not dependent on the opinion given in the last year. Of course, it will have some implications on the part of the auditor if the last year's audit report was clean or not. But to say it will be completely dependent on that may not be all right. And because of this, it will be limited to discussions, inquiries. Again, this may not be all right. So that's why option number D cannot be considered to be correct. Anjali is going with option number C. Okay. Now coming to option number C. Option number C says that it's okay to test bank and inventory, which is absolutely fine, because if these are appearing in the opening balances, then the auditor should perform audit procedures on the opening balances. So that means 3 and 4 should be tested, definitely. And the moment we say 3 and 4 should be tested, option number B goes off. Correct? Option number B goes off the moment we say that. Now the next point is around sales testing and purchases testing of the previous years. Whether that will be correct to be done on the part of the auditor or not. Now, when we talk about bank, when we talk about inventory, in terms of testing of their opening balances, how would that be done? Auditor will pick up any reconciliation statements of these banks of the previous years. Auditor will pick up the inventory valuation of the previous year. Only then auditor will get to know about the balances as at the opening day. Yes or no? Similarly, if let's suppose auditor wants to verify debtors, check the debtors. If the auditor wants to check the creditors as at the first day, as at the opening day, then how will that be tested? That will also be tested by looking at the transactions on a sample basis of the last year for which this testing would be performed. 1 and 2 would be performed. Yes or no? Yeah. So if that is done, will that be incorrect? The answer is no. So that's why what would be the right option? Option number A, that auditor may pick up any of these items depending on his judgment. And Ambika went with option number A only. Very good. Anjali is asking, only opening balance of banks and inventory need to be checked. Purchase and sales testing should not be done. And I think you must have understood this, Anjali, by now as to what's the perspective of doing all the 4 procedures over here. All right. Yeah. So this was all about this essay 510. Now what we can do is we can now move on to next essay, a very interesting one, essay 520, which is about analytical procedures. I'll just change the presentation now. Essay 520, which deals with some audit procedures in the nature of analytical procedures. So let's try to understand the meaning of analytical procedures. So we can get on to the definition of analytical procedures. Let's read. Analytical procedures mean evaluation of financial information through analysis of plausible relationships among both financial and non-financial data. Analytical procedures also encompass such investigation as is necessary of identified fluctuations or relationships that are inconsistent with other relevant information or that differ from expected values by a significant amount. Now, in relation to this, the choice of the auditor in respect of the procedures, the methods, and the level of application would be purely based on his judgment. Yeah. Now, in respect of analytical procedures, though we'll understand this in a better manner with the help of some examples. Let's read through the requirements in relation to substantive analytical procedures. So what are those requirements? First, determine the suitability of particular substantive analytical procedures for given assertions, taking account of assessed risk and the test of details, if any. Number two, evaluate the reliability of data from which auditor's expectation of recorded amounts or the ratios is developed, taking account of source, comparability, nature, relevance of information, and the controls over preparation. Next, develop an expectation of recorded amounts or ratios and evaluate whether the expectation is sufficiently precise to identify a misstatement that individually or when aggregated with other misstatements may cause the financial statements to be materially misstated, and determine the amount of any difference of recorded amounts from expected values that is acceptable without further investigation. Now, all of these procedures or all of these requirements, all of these considerations, we can best understand by picking up one example. And we can take one example of sales commission. And through this, we will also understand in a better manner meaning of analytical procedure as well as substantive analytical procedure. And we'll also try to understand how are these two different. Sales commission. Let's suppose the percentage of sales commission is 5% of sales amount. So that's the percentage. Okay. Now, if you look at the past years, say year number 1, 2, 3, 4. These are all last year's. Sales commission came out to 4% in this year, 3% in this year, 5% in this year, and say 3.5% in this year. So this has been the trend of sales commission. As per the contract, it has always been 5% of sales. Yeah, as per the contract, sales commission is always 5% of sales. And I'm talking about the contract of this company. So you can just name this company. Let's suppose this company is ABC Private Limited. Now, if we talk about current year, in the current year, we understand that the sales commission should again be 5%. Now, whenever any audit procedure would be performed in the nature of analytical procedure, so what is required to be looked at by the auditor? Auditor needs to look at the analysis of the financial statements by comparing the information of one year with another year, and by looking at the relationships which are possible. Something like this. In this year, sales commission was 4% of sales. And you may be thinking, why did it go down? Why did it not become 5%? Means, was this an error? Now, this was because of two reasons. That wherever sales commission was paid or payable, it was 5% of sales. But sales commission was not paid for each and every sale which was executed during the year. Means it was only towards the new contracts that the sales commission was payable. If the old contracts are continuing, if the old customers are continuing, so will the sales commission be required to be paid? No. So that means when this trend was looked at, or even if this percentage was analyzed by the auditor, he got to understand that sales commission cannot be picked up on entire amount of sales. So this is 5% of sales in case of new contracts, or we can say new customers. Understood? Yeah. Now, when this aspect was considered, now what would be required on the part of the auditor would be to break the sale into two parts. The sale which will have customers which are continuing, or the sales which is in respect of old customers, and the sales in respect of new customers. And then what can be done? Auditor would consider old customers amount with 0% commission and new customers amount with 5% commission. And this will be the total. Old plus new will be the total. Now, when he would check the percentage computation, the amount which is computed, so what would he get to know? He would get to know whether this comes out to be 4% or not. This is a kind of analytical procedure. Okay, clear? Now, similarly, auditor would have checked this in all of these years. Now, let's understand how would this audit procedure help the auditor. Now, when he would move to current year, for the purposes of testing of sales commission, two options are available to him. Option number A, he would do vouching, sample testing, etc. For the sales commission, he would pick up, samples, and he would do vouching, he would do testing on a sample basis. So first option available to him. What's the other option? Other option is to perform analytical procedures. And we will now try to understand which out of these two procedures will be considered to be more appropriate and why, and what are those situations under which these procedures will be considered to be more appropriate. Let's suppose if the auditor chooses to perform procedures as per option number A, will he be able to test the entire population? Let's suppose sales commission amount is rupees 30 crores and there are numerous transactions. So even though he will do this, can we say that he will be able to do this on 100% basis? Answer is not possible and not expected out of the auditor. If he will not do this on 100% basis, if he will do this on test check basis, can the auditor draw the comfort on this population of sales commission, say just by checking 5 samples? Can the auditor just simply say that 5 samples have been testing, everything was okay, and that's why this entire population can be considered to be one which doesn't have any material misstatement? It may not be really less, yeah. So it may not be such a satisfying procedure by the auditor. So then what do? We can look at option number B now. In option number B, what would the auditor do? In option number B, auditor may perform a procedure like this. Okay, so now in this case, he may perform something like this. He may say that for the current year, what's the turnover of the company? This 30 crore, I have to just compute this once. Let's suppose sales of the company for the current year was 1000 crore. Okay. Now, he may apply this 5% over here and draw his expectation that sales commission on this entire population should be 50 crore. Means he will set up a maximum amount because it cannot cross this if the sales are tested appropriately by the auditor, on which he will perform some procedures. So we are not talking about sales. We are saying if we consider this sales to be okay, and if the auditor develops this expectation of 5%, then what is the number that he will get? He will get a number of 50 crore. So if the sales commission happens to be 50 crore, he would be fine. Otherwise, he will not be fine. Okay. Now, in the given situation, sales commission comes out to 50 crores as per the expectation of the auditor, but actually it is 30 crore. So now there is a big gap. So what will now be done by the auditor? Now he will fine tune his information. Now he will request the management to break the sales into 2 parts. The one which is arising due to new customers and the one which is arising due to old customers. Okay. So let's suppose if he gets the information something like this. Say he gets to know that sales for new customers was 610 crore and the sales for old customers was 390 crore. Okay. Now what would he do? He would not compute any sales commission on this, and he would compute sales commission on this at the rate 5%, which would come out to 30.5 crore. This comes out to 30.5 crore. Correct? Yeah. So now there is a gap. What's the gap? On the basis of whatever he understood from the management around the sales commission, he bifurcated the information and got the required information, and he created an expected amount. Expected amount means he knows that the actual sales commission is 30 crore, but he also recomputed this amount as per his understanding which he has obtained and as per the contracts of the company. And as per the auditor, this amount should have been 30.5 crore. But if the amount is actually 30 crore, now what would the auditor do? Now the auditor would again have a discussion with the management to understand the reasons why this is 30.5 crore. Means why this 50 lakh additional amount has not been captured. Now for this, there may be various reasons. First reason, and very simple one, is that it's an error. That 50 lakh of the commission amount has not been recorded. First option possible. Second option, maybe even though these were new customers, still management had some option to negotiate around the sales commission percentage with some of the parties, and which they did well, and that's why they were able to save 50 lakh of the commission amount in the current year, and that's why it went down to 30 crore, and for which management would have some evidences available with them, and which can then be reviewed by the auditor. Yeah. And again, there could be various reasons for this. Now let's suppose if we go back to these options number A and B, and if we try to compare both of these procedures, procedure number A didn't appear very satisfactory. You remember? It didn't appear very satisfactory. But just by performing option number B, or can we say that by performing only procedure number B, auditor would be done in terms of this entire sales commission area, which is of huge amount? Can we say that just by drawing this analysis, it will be good enough on the part of the auditor? Say if the auditor does this analysis like this on the data provided by the management, he gets to know it's 30.5 crore, and on which management is saying it's 30 crore. So the explanation has been provided and auditor is looking at it. So can we say that will also be sufficient? The answer again may not be yes. Why? Because even if we look at the analytical procedure, one good thing in case of analytical procedure is that now by performing this analytical procedure, auditor is getting comfort over the complete population in a better manner as compared to this procedure. There's no doubt about it. But even though more comfort is obtained on the entire population as against sample testing of some selected items, checking, verification or authentication of all of these data is not done by the auditor. It's only the computations, etc., which have been done. And till the time any evidence is not obtained by the auditor, can that really be trusted by him? The answer is no. So that's why whenever any analytical procedure is performed by the auditor, that needs to be substantiated. That needs to be substantiated with the underlying data. If the management says that the sales commission should be 5%, what is it that the auditor needs to verify? He needs to look at the sample contracts. to check what's the percentage. Is it really 5% or more or less? If the management says that the sales commission would only be payable for the new customers and not for the old customers, this again needs to be substantiated by looking at the underlying data. It just can't be the discussions with the management. If the management says that in the current year there have been some good negotiations on the basis of which they were able to save 50 lakhs and because of which actual expenditure comes out to 30 crores. There again, auditor needs to look at the evidence and auditor needs to also analyze and discuss with the management that why was this only 50 lakh? Why was not this below 50 lakhs? And what's been the past trend? In the past years, has this actually been done? And which will again be requiring looking at certain documents by the auditor. To substantiate this understanding, understanding which he obtained from the management. And when the auditor substantiates all of these things by looking at the information, data, or the supporting documents, that is called as substantive analytical procedure. So now, what can we say? That whenever it comes to audit, just by doing substantive testing means other than analytical procedure may not be good enough at times. And performing only analytical procedures, excluding any of the substantive testing, will again not be appropriate, will again not be sufficient. So that means both of them should be done. So a mix of both of them should be performed by the auditor. Clear? Yeah. So that means this should not really become an option, but a mix of these two is something which the auditor will always want to plan and verify. Clear? Yeah. So this was only an example of analytical procedures. Now, as around analytical procedures, let's pick up a few more things. We can pick up some more points around the analytical procedures. Analytical procedures could be of various types. Very commonly, if we look at the variance analysis, means comparison of the information of 2 years. So we have data of 2 years, previous year and current year. If that is compared, then the comparison of these two will give us some analysis. So let's suppose sales of the previous year compared with current year. So this has increased by 10% or say decreased by 5%. So this will give some insights about the business of the company, about the operations of the company, and which can then be further analyzed by the auditor. Correct? So this is called as comparison of 2 periods. Number 2, this current year information of the company may also be compared with industry data. So what does it mean? We understand that in the current year, sales of the company have increased by 5%. But the industry has been facing challenges throughout the year. And throughout the industry in which the company operates, declining trends of sales were observed. These were all declining trends for the current period. Then what has been so special in this company which has resulted in increase in the sales amount. Now this can be one point of consideration. Yeah. What is so special in case of this company? This needs to be analyzed. This needs to be carefully checked. So this is again some sort of analytical procedure, yeah, or one way through which data or the information of the company may be analyzed. Clear? Another way through which substantive procedure, this analytical procedure is generally performed in respect of the expenses or the incomes is by developing the expectation. So we can pick up some examples, say of expenses. We can develop some examples, say of expenses. Now in relation to the expenses, say if we talk about expenditure of power and fuel. Say of power and fuel. Now as around power and fuel, there could be an understanding which the auditor may want to obtain first of all. And what's that? That this expenditure has got some linkage or say direct linkage to the production. So that means if the production will increase, then this expenditure will increase. And if the production will go down, then this expenditure will also go down. Okay. Now, if that is the situation, then this power and fuel can be said to be having a cost driver. Cost driver. Cost driver means what is driving this expense? What is driving this expense? So this expense is driven by the production, which if increased will increase this, which if decreased will decrease this. So whenever this expenditure will be analyzed, this should be analyzed as a proportion of this. If the production has increased during the year, then this should increase. But if this is increasing, if the production has increased, then this should increase. But if this is decreasing, then once again, this needs to be analyzed further by the auditor. All right, clear? Salaries. Now for salaries, what can be the cost driver or what can be the basis of its analysis? If we have to look at the salaries, what can be the basis of analysis of salaries? We can say it's the number of employees, or we can say headcount. Headcount. Now, how do we get the headcount? Headcount is the information of the company. So, company will have the data around the headcount. If the number of employees will increase, then definitely this expenditure will increase. If the number of employees will decrease, then definitely this expenditure will increase. But this may not be in direct linkage to the number of employees. Why? Let's suppose average salary was say 25,000. Average salary per employee was 25,000 in the previous year. And in the current year, average salary per employee has increased to 40,000. Now, if we look at the number of employees, those were 100 last year and those are also same in the current year. Or even if those have changed, let's suppose it's only 2 more employees who have come. Now in this situation, if the analysis has to be performed, how would the analysis be done? If we say that the number of employees has not changed, it has remained same, but the average salary has gone up. So how is it possible? One could be because of increments. But when it comes to increments, we understand that the policy of the company is to have increments around, say, 8 to 10%, because of which this average salary should have become, say, 28,000 or 27,000. But this has jumped to 40,000. So what could be the reason for this? The reason for this could be that out of these 100 employees, say 20 left, which were having lower salaries levels, and 20 more have joined, and who are in higher salary buckets. Okay, or maybe that out of these 100, say 30 left and 30 joined, and out of these 30 who have joined, 5 employees are at the senior management level, whose salaries were in the lower bucket, in the lower brackets in the previous years. And now the hiring which has been done has resulted in significant increases in the compensations of those high level management employees, because of which this average salary seems to have increased significantly. Okay, clear? Now, one thing is very, very clear, that analytical procedures on a standalone basis cannot provide sufficient appropriate audit evidence to the auditor. They have to be looked at along with substantive testing. And in respect of analytical procedure, auditor will have to get into deep understanding of each and every variance which may arise. For example, something like this. In this case, when the auditor would have computed the average salary, it would be better for the auditor to break the salary level into 2 parts. Say salary of blue collar employees and salaries of white collar employees. When the average of these 2 categories would be compared, then this would not give such a distorted picture. Possible? Yeah. And the auditor would be able to draw better analysis out of these things. Again, possible? Yeah. Secondly, even if all of these assessments have been done, all of these things have been understood, these are based on what? These are all based on discussions of the auditor with the management, with the various client personnel. But just by having discussions, just by having verbal discussions, auditor cannot conclude his audit procedure. So that's why all of these reasons of variances which the auditor would understand from the management, it is important that out of those samples or out of the population on which this procedure has been performed, on this analysis has been performed, some of the samples are selected and then verified by the auditor, that whether this statement of the management that now new employees have come in who are into higher salary brackets as compared to old ones. So what can the auditor do? Auditor can just quickly check 2 of the old employees who left, what were their salary levels, and 2 of the new employees who have come, what have been their salary levels. Yeah, so through this, he will be able to substantiate the understanding which he would have obtained from the management. Clear? Yeah. Now, another very important point in case of analytical procedures happens to be the data, because it's all data which gets analyzed, and therefore it's again important that the data which is received by the auditor which is analyzed by the auditor is correct. Because if the data is incorrect, then the analysis will automatically go wrong. And what's the basis of ensuring that the data is correct? Again, the same thing. Simple testing or the testing of the data by picking up certain samples. So we are not saying that samples have to be too many, or it's all based on the sampling technique which one has to follow. But it's very important that the data which has been obtained by the auditor is absolutely fine, because if the data will be incorrect, then all of these analytical procedures will not provide the correct picture to the auditor. He will not be able to get onto the correct thing. Yeah, clear? And another thing is about the source. See, all of this data which the auditor obtains in respect of performing the analytical procedures will of course be the books of accounts, but at times there could be various other sources through which auditor is drawing the information and making the comparison. For example, this industry data that we talked about. So therefore, it becomes again important on the part of the auditor to ensure that the data which he has been obtaining, whether it is about the internal data of the company or some external data which he is using for his analysis, is substantiated by him, is reliable. Because if he'll be looking at some unreliable data, then that will not lead to the audit procedure which is satisfactory. Nagasai is asking, sir, how do we know the industry data? See, industry data is available in the public domain most of the times. There are also certain websites, there are also certain sources which are available on paid basis, which at times are used by the auditors and which are mostly used by the management also in terms of getting a lot of information. Yeah, and these are very common things which you get to see. Okay, and all of these sources, as I told you, should be reliable. And how do we test the reliable? We need to obtain an understanding of how the information have been picked up from those sources. Let's suppose if you do Google, yeah, and you capture some information, you capture some data about the industry, and then you compare that to the data of the company. You need to just ensure that the information that we have obtained from Google, whether that was correct or not. Okay. Now, if the data which is obtained from the public domain is wrong, and if that is compared with the information of the company, then of course the analysis will be of no use. That will unnecessarily lead to confusions only. All right, clear on this? Yeah. So this was all about analytical procedures. As I told you that analytical procedures are all about analysis which are required to be drawn on the financial statements, and this is something which is technical at times, and this is something very interesting. So if you analyze all of these analytical procedures, if you perform these analytical procedures, this could be at various stages. This is not something which will be done by the auditor during the course of his execution. Even before the auditor would start the work, when he will obtain, say, draft financial statements or the first level financial statements, he would want to do this analytical procedure. He would want to compare the data of the current year with the previous year as to what have been the changes, which will give some insights immediately to the auditor that this is how the numbers are behaving, this is how the numbers are changing as compared to the last year. For which auditor may plan to have discussions with the management, auditor may plan to have certain additional procedures which will also lead to the risk assessment of the auditor. And then of course, during the course of his audit, we will be doing analytical procedures on many items. And once the audit is completed, once the financial statements are finalized, means when the final picture of the financial statements is made available to the auditor, and that time also auditor will do the analytical procedures to once again check whether all the numbers which are now flowing into the financial statements are in line with what all are in line with all the procedures which the auditor would have performed. Yeah. So this is again a continuous process. Yeah, which keeps going on till the time audit is complete. So this and actually starts from the planning stage itself. Okay. Yeah. Clear. So with this, we are done on this auditing standard, and now we can take a break. If you have any queries, you can just let me know your queries, and after the break, we'll start with another auditing standard. And in case you have any query, we'll also look at those queries. Okay. Yeah. So let's take a break. Hi, welcome back. So we'll now start with another auditing standard on audit sampling. And in between, I have this query from Ambika who is asking, so can we use analytical procedures in risk-based audit approach? Of course, yes, because audit is all about risk-based approach now, and wherein analytical procedures will help the auditor to a great extent in terms of risk assessment by throwing up certain areas which may have significant fluctuations. And in terms of the risk assessment, it's the first thing which the auditor can analyze. So the first insights about the data or the information which the management may have finalized at the first instance would be easily reviewed by the auditor with the help of analytical procedures. So now moving on to next auditing standard. This is about audit sampling. And in relation to audit sampling, we understand what do we mean by this audit sampling, because we have discussed about audit sampling already quite a lot. In terms of audit sampling, one thing which the auditor needs to understand is the basis of the audit sampling. Now, as regards the basis of the audit sampling, even though this standard gives us various ways through which this sampling can be done, eventually it all comes down to the judgment of the auditor, because sampling is all about professional judgment of the auditor. And one thing is for sure, that because each and everything cannot be tested by the auditor, that's why we have this sampling technique, which simply talks about picking up some items out of a whole lot of population and which is then tested. But the sample should be selected in a way that it provides the comfort to the auditor in respect of complete population. And in technical terms, we can say sample should be selected in a way which is representative of entire population. So let's first of all understand the meaning of some terms which will be used over and over again in terms of this auditing standard. Audit sampling, and which is also called as sampling. So what do we mean by this? Application of audit procedures to less than 100% of items within a population of audit evidence, such that all sampling unit means samples, have a chance of selection in order to provide the auditor with a reasonable basis on which to draw conclusions about the entire population. Okay, this would be considered to be audit sampling. Or in simple terms, we can say that picking up some samples out of the total population. And when those some samples are picked up from the total population, those should be representative of the entire population. Clear? Okay. Now, what is this population? Population means the entire set of data which is received, on which audit procedures are required to be performed. So let's understand this with the help of one example about this sample and the population first of all, and then we'll move further to understand some more terms. Let's suppose we have the data of sales for a company. So the sales information is given to us. Okay. So these are various sales transactions which have occurred during the year. And the total, let's suppose, of the sales amount is 150 crores. Total sales is 150 crores. Now this sale or this sales amount needs to be tested by the auditors. That's why this entire data or this set of data is termed as population. Clear about the meaning of population? And because this entire data cannot be tested on 100% basis, so that's why auditor will pick up some samples. Let's suppose this one is selected, this one is selected, this one is selected, this one is selected, this one is selected. Yeah, this one is selected. All of these samples which the auditor would select are considered to be sampling units, or you can say all of these transactions which have been picked up are called as sampling units, or we can say samples. Okay, yeah. Let's move on to understand some more terms. Sampling risk. What is this sampling risk? The risk that the conclusion of the auditor based on a sample may be different from the conclusion if this entire population were subjected to same audit procedure. Sampling risk can lead to two types of erroneous conclusions. Number one, in case of test of controls means tests of internal controls of the company. In case those are tested, controls are more effective than they actually are, or in the case of test of details, that a material misstatement does not exist when in fact it does. The auditor is primarily concerned with this type of erroneous conclusion because it affects audit effectiveness and is more likely to lead to an inappropriate audit opinion. Another type of error which is possible is in case of test of controls, controls are less effective than they actually are, or in case of test of details, material misstatement exists when in fact it does not exist. This type of erroneous conclusion affects audit efficiency, as it would usually lead to additional work to establish that initial conclusions were incorrect. Now, these are certain limitations of the samples, and these cannot be ignored. Why? Because audit, first of all, cannot be conducted by picking up each and every sampling unit. Yeah, so that's why auditor has no choice but to do his testing on a selective basis, and that's why auditor has no choice but to take this risk. And how would the auditor ensure that this risk is minimized? By applying his professional judgment, using his professional knowledge, using his experience in respect of various audits he would have performed. Another risk is called as known sampling risk. The risk that the auditor reaches an erroneous conclusion for any reason which is not related to sampling risk. Okay, yeah. So let's now come to this example, and with the help of this example, we will now get into further details of the audit sampling and the sampling technique, etc. Now, as around the sampling technique, various methods of sampling can be done. First and very common method happens to be random. Means when the sampling is done on a random basis. Random means any item out of this population can be picked up. So it's like, let's suppose there's a basket on which there are so many balls, and we just pick out any ball without looking at any of the balls, and each and every ball has chance of getting selected, of getting picked up. Same is the case in case of random selection, that each and every transaction has a chance of getting selected. And when this is free from bias, it's done in such a manner that each and every transaction, each and every this amount is having equal chance of getting selected. Then it is considered to be a technique or the sampling technique wherein samples have been picked up and which will give the auditor the comfort that those samples which are picked up are representative of the entire population. Okay, so this is one type of technique or the method. Now, as around this method, again, there's no fixed formula, or we can say there's no fixed criteria on the part of the auditor that whether this method should be used by the auditor or some other method should be used by the auditor. What can be some other methods? Those methods will again be dependent on the judgment of the auditor. Let's suppose auditor wants to follow some system. Say he wants to pick up first 10 transactions, then leave 10 transactions, then pick up another 10 transactions, then leave 10 transactions. Okay, so it's a sort of system which he would have tried to create. In respect of this system which he would have tried to create, what's the judgment of the auditor? Again, he needs to think through. He needs to understand why that particular method or technique he would want to follow. If he appears that to be more appropriate considering the nature of the information which is available, then of course there is no problem in this. But one thing is for sure, that sampling method or the technique has to be bias free. The moment it becomes biased, then absolutely, then this will absolutely be a big problem for this entire audit procedure. Yeah. Now, as around these sampling techniques, some of the ways through which samples are picked up are not really limited to this random or this picking up of any of the items. Many a times, depending on the nature of the information which is provided to the auditor may want to further do some sort of say analysis of the information, or some sort of approach in terms of selecting the sample, wherein whatever he wants to pick up in terms of the information which is available is getting picked up. So let's understand this with the help of an example. Say auditor understands that the company operates in 2 regions. That means sales are in northern India and in eastern part. Means company is operating in these 2 geographies only. All right. And the data which is currently received by the auditor comprises of sales of both the regions, both the places. Secondly, in these two places, company operates into two products. Product A, product B. Okay, and once again, the data which the company has provided to the auditor is all mixed up. Okay, so that means sales of A and B both are covered in this data, and sales in both these regions are covered in this data. Now, auditor wants to ensure that if he wants to pick up some samples, then he gets a sample for both the types of products sold during the year, which is possible. Yeah. Now, if the auditor would apply random selection technique, or say any technique, now what may happen is that all the samples which get picked up, they may be of product A, and there is no sample of product B if it's only random selection which has been done. Yes, yeah, it's a possibility. Or maybe majority of the samples are for product A, and there are only very few samples of product B which auditor wants to increase. So then in such a situation, what will happen? Auditor will have to increase the sample size. This is first option. Or otherwise, a better methodology would be to break this population into two parts. Say this population has got two parts. This part is for product A and this part is for product B. Now what can the auditor do? Auditor can apply his sampling technique on this one and this one, because of which his objective, his requirement of picking up the samples related to both the products would be fulfilled. Number two, he can then further divide this population into two more ways. Say this part of the population is towards first region and this part of the population is towards second region. Now what can the auditor do? Now once again, auditor will ensure that this population is population 1, this is population 2, this is, let's suppose, population 3. Yeah. So for this entire population, what has the auditor done? He has created 3 buckets. And out of these 3 buckets, he will now draw the data. He will now draw the samples. And because of which, he will now be able to get the better samples, which will be covering all of these types of transactions at all of these places. Correct? Yeah. And this is possible only when the auditor understands the process. Auditor understands the information that is received by him. Because only with the understanding of the information which the auditor would have received, he would be able to apply such sort of technique. This is called as stratification. This technique that we have discussed is called as stratification. Clear? Yeah. And this is very commonly done. Very, very commonly this is done because most of the times auditors would want to pick up samples to ensure that every type of transaction, it's not every transaction, every type of transaction is at least covered with few samples or maybe 1 or 2 samples depending on the volume of the data which will be there to test. So this is one. Secondly, when it comes to sample selection. Now, what should be the number of samples? So all of these discussions that we have had so far was all about how to select the samples. Means which all types should get covered, and depending on the information, which all areas should not get missed out. This is all good to understand, and this is all important. But at the same time, how many samples would be selected on a given population is once again a matter of judgment. Now, for doing this, one of the things which auditor generally follows happens to be materiality. Now, what is materiality? Materiality again is the same thing. That's the threshold which the auditor picks up. Nowadays, in relation to audit, there are various tools, or I would say there are various online tools available, automated tools available, which are used by the auditor. These days, various tools are used by the auditor, using which sample selection is also done. And in fact, that happens to be very commonly done for sample selection. Wherein it's all unbiased, it's bias free, and wherein all of these random selections are possible, and which also requires setting up a threshold basis which the tool helps the auditor to understand what should be the number of samples. That means what should be the sample size. Say for example, if the population is of 150 crore, should the samples to be tested be 10? Should this be 15? Should this be 25? Or should this be 40? So this is how those tools also help the auditor. But having said that, it's all about professional experience of the auditor. It's all about judgment of the auditor, which plays a very, very important role in terms of sample selection, in terms of the number of samples which are decided. Yeah. So how should the sample number be decided? On the basis of materiality, the threshold, but at the same time, on the basis of the threshold or the materiality again is judgment. So that's why careful evaluation has to be done by the auditor in respect of materiality or all of these thresholds. Many a times, one common basis which most of the auditors follow is about picking up high value items. For example, say if this is the sales chart. In the sales chart, auditor may want to ensure that top 5 sales transactions are tested. What do we mean by top 5? Means 5 sales transactions of the highest amount, which can be picked up for the entire population, or which can be picked up for product A top 5, product B top 5, then this region top 5, this region top 5. Yeah, and again, this 5 is not a fixed number. This is only illustrative. This is only an example that I'm sharing with you. But very commonly, this becomes the criteria. Or at times, the auditor may also want to do that any sales transaction wherein the sale amount is more than 1.5 crore, for example, will be tested by him. Why? Because on the basis of the discussions with the management, auditor may understand that the sales invoices generally range from 50 lakhs to 1 crore. Yeah, that's the amount of the sales invoice. Generally, this is what auditor understands. So that's why it will be good for the auditor to understand and good to look at those transactions which are unusual. That means if an invoice is raised, let's suppose for 1.5 crore, single invoice is raised. So what's the reason for that? Similarly, because the company issues invoices amounting to 50 lakhs to 1 crore, so that's why if there is an invoice which has been issued only for 2 lakhs, or say 3 lakhs, or say for 50,000 rupees. Yeah. Now, once again, what are these? These are all thresholds. And to pick up all of these thresholds, what is again required? Judgment on the part of the auditor. Auditor will use his judgment to pick up all of these thresholds. Yeah, and these thresholds will again vary depending on the area that is selected. Though the materiality is common and single for the financial statements as a whole, but threshold will be set up on the basis of various areas. Maybe for revenues, the threshold is different. Maybe for certain expenses, the threshold will be different. Why? Because the revenue for a company could be 150 crore, but when it comes to, let's suppose, for testing of an expense which is in the nature of printing and stationery, the total amount of that expense could be as low as 10 lakhs. So we cannot really set the threshold of the same levels which would be set up for sales, yeah, and which will be then used as the basis for the sample selection. So these will have to vary. In the meantime, I have a couple of queries. Let me just so Harshad has a query. It's about the material. I understand that there are not many significant changes, but I think on this query we'll just come back to we'll come back to your query towards the end of the session, Harshad. Yeah. And Nagasai has a query about names of see, there are a lot of tools which are available, and a lot of large firms also use different tools. They're not really the names, it's the names which are assigned to those tools by the firms or by the users at times. But some of the common tools which you can see is about IDEA. IDEA is like very commonly used tool. And some of the tools are also developed in-house. So these keep varying. There's no fixed name which one will assign over here. Okay, now moving further onto the sampling technique and onto the misstatements. Now samples are picked up because auditor wants to ensure that the data given is correct. Now let's suppose if the auditor has selected a sample of 45 over here. 45 means 45 sales transactions have been tested, let's suppose. Now when the transactions have been tested and all of them happen to be error-free, let's suppose all the samples which have been tested are all fine. So there are no misstatements, no errors. If these are all error-free, no misstatements, no problems, then the conclusion of the auditor would be that the entire population is all right, means entire population is absolutely fine. So auditor will draw the conclusion based on the sample selected. But let's suppose if out of the samples, some samples show some errors. Okay, so there are some errors or misstatements found in some samples. Now in this case, there will be two courses of action for the auditor. One, because this was only a sample of the population, this was not the population in totality. That's why the auditor may now want to increase the sample size, considering the misstatements or the number of misstatements which the auditor would have identified. Why? Because his comfort level has gone down by looking at only those samples and finding mistakes in those samples. Secondly, in respect of the misstatements that he would have found, auditor may want to check, discuss with the management the impact of those misstatements. Maybe the mistake is only found in one sample, but the mistake is such that in all other samples, or maybe in the samples which are of that nature, such mistake is possible. So that will require sort of adjustments in relation to those errors which have been identified. And needless to mention that if the errors are crossing the materiality threshold, then the auditor will have to necessarily get those corrected in the financial statements. If those are not corrected in the financial statements, then this will lead to reporting implications on the part of the auditor. Clear? Now, another thing which becomes very, very important on the part of the auditor is that when the auditor is selecting a sample, this entire population is getting represented by that sample. So that means even if a sample is selected, say this sample is selected, this sample is selected, this one 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 is selected. And all of the samples do not contain any misstatements. So 45 samples selected, there are no errors in them. They are absolutely fine. Does it mean that out of this total population, if only these 45 samples are selected and those are found to be absolutely okay, would it mean for sure that all other transactions which have not been selected by the auditor would be absolutely error-free? Can the auditor say this with confidence? Can this be said with absolute accuracy? The answer is no. Answer is no. Till the time each and every transaction is not tested, auditor cannot say this for sure that all other transactions are absolutely error-free. So it's a risk in a way which the auditor has taken. And this is permitted to the auditor by the auditing standard to take this risk because auditor doesn't have any other choice. But because there is a risk which exists in respect of non-checking of the data, what would auditor do? Auditor would always create a cushion for himself. And what is that cushion called as? If you go back to our discussion on the materiality, auditor would reserve some cushion. Okay. So this was the threshold which we said, which was CTT. Okay, which was a very, very small amount. So I'm not talking about it. Let's suppose the materiality for the company is 50 lakhs. Materiality is 50 lakhs. And this is what? 50 lakhs as the materiality. We understand that irrespective of the experience, irrespective of the judgment of the auditor, his professional knowledge, there are still chances of errors getting undetected, of staying in the financial statements. Why? Because of the sampling technique, because of the selective data which is tested by the auditor. And that's why auditor would need to have some cushion. And that cushion again is not specified by the standard. This is again based on the judgment of the auditor. Basis which materiality is cut down to a threshold which is called as performance materiality. Performance materiality. And let's suppose that cushion is given equivalent to 20% of the materiality. So performance materiality will be what? 80% of materiality. So 40 lakhs will be the amount which will be set up as the materiality level, on the basis of which sample selection, testing, etc., everything will be done. And this cushion of 10 lakhs is reserved for what? This is reserved for those errors, those misstatements, which may stay in the financial statements, even if the financial statements are audited. Okay, yeah. And therefore, whenever this sample selection or any of these procedures are done, those are always used basis this number instead of this one. Clear? Yeah. Nagasai is asking how to minimize the sampling risk in relation to detection risk. See, the first and the most important part for that will be to understand the nature of the business, understand the processes of the company, so that the auditor can design his procedures very well. Number two, if the company will have good internal controls, strong internal controls, which are operating effectively, then definitely the audit risk or the risk of misstatement would get minimized. And if the misstatement risk gets minimized, then any such risk which may arise because of sampling, or which could be related which could be related to any of the line item of the financial statements or the financial statements as a whole, which may not get captured, say for example, even if by the audit procedures or by this audit sampling, will automatically get minimized. Yeah, clear? And of course, needed to mention that auditor needs to be very, very careful. There are also certain techniques which we have discussed in terms of picking up any of these techniques in relation to various areas which are tested. And there are a whole lot of procedures we have been discussing. It's not only about the testing procedure that we have discussed. Testing procedure also needs to be combined with control testing, that also needs to be combined with analytical procedures, and through this mixed bunch of procedures that the auditor will perform, auditor can get some comfort around the financial information. All right. So with this, we may end our discussion in relation to this auditing standard, and we move on to the next auditing standard about SA 540. Change this. Okay, moving on to this next auditing standard, SA 540. Very, very important auditing standard, and very, very important standard in terms of its practical application. Theoretically also, for the purposes of all of you, this standard is considered to be important. But practically, these days, the focus of the reviewers has increased significantly to some of these areas which are captured within this auditing standard. Accounting estimates. Accounting estimates means those areas of the financial statements or those items of the financial statements wherein the amount cannot be given with 100% accuracy. Some sort of estimate got involved in relation to those amounts. Some sort of estimate got involved in relation to those amounts. Okay. And because those estimates are not accurate, those are not 100% accurate, so that's why all of those estimates may also be subject to manipulations, which are possible. All of these amounts, all of these items in the financial statements, if required, may be manipulated easily by the management of the company. And that's why it's extremely important on the part of the auditor to perform procedures on all of these items very, very carefully. And unfortunately, most of these areas are the ones on which audit procedures at times are not performed at all, or are performed with or are not performed in line with what is required by the auditing standard. So first, we can just move on to our understanding of the audit estimate, and then we will try to understand as to what does the standard requires. Accounting estimate. What do we mean by accounting estimate? An approximation of a monetary amount in the absence of precise means of measurement. This term is used for an amount measured at fair value where there is estimation uncertainty, as well as for other amounts that require estimation. Where this essay addresses only accounting estimates involving measurement at fair value, the term fair value accounting estimates is used. So let's try to understand about accounting estimates first of all, before we move on to our further discussion in relation to the audit procedures which need to be performed as around these items. So what are accounting estimates? If we talk about useful life of PPE, this is something which is very, very easy and very, very commonly known to all of you. Useful life of PPE. What do you call it as? Quickly, all of you. What do you call it as? Can we say that useful life of PPE is an estimate? Will it be right to say that it's an estimate? The answer is yes, of course. Similarly, if we look at the residual value of PPE, what do we call it as? Again, it's an estimate. Why are these estimates? Because let's suppose if we purchase a building, we cannot say with 100% accuracy as to what the life of this building is going to be. We may estimate that to be 30 years, but this may turn out to be say 50 years, or this may turn out to be say 25 years. And with passage of time, we keep getting more and more clarity around such things. Okay. Similarly, if we talk about residual value, let's suppose a laptop has been purchased So we estimate that after 3 years, this may have a residual value of say 5%. But after 3 years, this may have a residual value of 0 only. Why? Because of changes in the technology, which may have been done significantly over the period, which was not the expected thing when the laptop was purchased, and due to which a lot of revisions kept coming. Now let's try to understand around the impact assessment. Say in the first 3 years, the management kept the life of building to be 3 years. Okay. And because this was only an estimate, this was subject to this was subject to variations. This was not something which was 100% accurate. Management decided to change the life. Let's suppose after the end of 3 years, management estimates that the life of the building will be 20 years as against 30 years. Can this be done? Yes, of course. If the management has good reasons to do this, this can be done. There is absolutely no problem in this. And you may be thinking, but it's a significant change. And that's why they have taken time to change this. It's not something which is done within 1 year or overnight. Okay. Which is absolutely okay. Now at times, one may think that the company has been getting good profits over the periods. And the company is also expecting to have good profits over the next years. And that's why to increase its depreciation charge, company wants to cut down on the life of the building. Because if they increase on the depreciation charge, what will happen? They will be able to show lower profits. Correct? Or maybe earlier it was 20 years. Initially when the building was purchased, it was kept as 20 years, and now the company wants to increase it to 30 years. Why? Because the company wants to increase its profits, and that can again be done by just simply cutting down on the depreciation expense, which is again absolutely okay. Yeah. So in this case, we understand that this accounting estimate may be manipulated by the management. It's possible. So we are not saying it will be done always. No. It may or may not be done. But this is something which is possible, which can be done by the management. So that's why to perform procedures on this, to ensure that any of the changes which are taking place over here require appropriate audit procedures, so that manipulations are not made by the auditor. And what can be the audit procedure on this? Audit procedure on this, at the first place, when this life was assessed, let's suppose this was assessed as 20 years. So what would be the audit procedure? Audit procedure would be to understand the basis of considering this life by the management. Because when the management would have considered this life, it would have considered some basis. Auditor needs to get into the basis of this. Understands that. Auditor can also look at the buildings which are within that area and which would have been analyzed by the management also in terms of assessment of the useful life. If all of them were of 30 years, Or let's suppose if the company is having other buildings for which lives have been kept at 30 years, but for this has been kept at 20 years. What has been the reason of doing this? Clear? Another very common example in respect of accounting estimates is actuarial valuation. Actuarial valuation. Now, what is actuarial valuation? If some of you don't know, actuarial valuation is all about valuation of employee expense. Okay, so it's a valuation of employee expense. For example, gratuity, which happens to be a defined benefit plan, is required to be valued by an actuary. Okay. Now, when the actuary values the liability in relation to that benefit of the company, that is again what? That is again an estimate. This is again an estimate. And for doing this valuation, what has the company done? Company has engaged an expert. Company has engaged an expert for the computation of the actuarial valuation. Now, in this case, what is required on the part of the auditor? Let's try to understand. We may say there are two options which are available to the auditor, and I would request all of you to also comment on this. What do you think will be the right procedure on the part of the auditor in the given scenario? Because the actuarial valuation is carried out by an actuary. Who is the expert? Actuary. Actuary is an expert. Actuary is an expert of his area who has been appointed by the management, and because he is doing the valuation, he also issues a certificate. Actuarial valuation certificate is issued by him to the company in relation to the valuation as at the reporting period. So let's suppose he did the valuation as at 31st March 2020. So he will also be issuing a sort of certificate. So first option is to say as an auditor that we have looked at the actuarial certificate. We have verified that the amount which is recorded in the financial statements by the company is based on what? This certificate. Okay. And that's why auditor is able to draw conclusion that yes, this valuation has been appropriately recorded in the financial statements. Number one. And what's the basis of saying that? Because the management has involved an expert and who has issued certificate to this. Okay. This is option number one. Option number two. Irrespective of who is engaged by the management, means whether the valuation is done by the management itself or management gets it done through an expert who also issues a certificate in respect of that. Auditor performs his procedures, his audit procedures on the valuation. How will that be done? That's a separate matter. We'll get into that. But for the time being, we are saying the second option is the one wherein auditor is just not simply relying on the actuarial certificate, actuarial valuation as it is. Auditor is looking at performing his audit procedures on the valuation. All right. Yeah. Now, in this situation, in this case, which out of these two options you will consider to be better? Now, in this case, which option you will consider to be better? All of you, quickly. Both the options appear to have some logic, and both the options may be considered by the auditor. Yeah, it depends on situation to situation basis. Could be one of the answers, or maybe that option number 1 could be the right answer, or maybe that only option 2 is the right answer. So what do you think? Yes, you can also share your views on this. Now, as around the financial statements, as around the preparation of the financial statements, we need to just go back to our understanding of the fundamentals. Preparation of financial statements is the responsibility of who? Management. So if the management takes the help of an expert in respect of its preparation, it's one and the same thing, because management is held responsible for the financial statements preparation. But as around the audit of those financial statements, whether those have been completely prepared by the management involved some experts, or management put together a team which prepared those financial statements, does it really matter to the auditor? No. Eventually, the audit of the financial statements as a whole is the responsibility of whom? Auditor. And auditor would be responsible to express an opinion on the financial statements as a whole. Can the auditor say that on the financial statements I am expressing my opinion except for this valuation which has been carried out by an expert on whom I am placing reliance? The answer is no. This is not possible. And that's why when the auditor does this procedure of simply relying on the certificate issued by the actuary, can that be considered to be appropriate? Absolutely not. Auditor cannot do that, because if he is doing that without performing his own procedures, see, to look at the certificate is also procedure to ensure that the amount which is appearing in the certificate goes to the financial statement is also an audit procedure. But to check that the amount which has been computed by the actuary is correct or not is also the responsibility of the auditor. Because if this amount is not checked, what is happening? In a way, the amount which is flowing into the financial statements goes wrong. Okay, so Anjali shared that answer number B is correct. And Anjali is saying it can be both also, sir. All right. Now, on the basis of this discussion that we have had, that it's the responsibility of the auditor completely. So what would the auditor be required to do? Auditor would now be required to ensure that this valuation is as per the required standards. Or in simple terms, we can say that this valuation is free from material misstatement. And let's try to now understand what can be the procedures which auditor may perform to ensure that this valuation is free from material misstatement. One, in relation to this expert, because the management has hired him and he is the one who is computing this, the first thing which the auditor should check is whether he will have the right skill, whether he will have the experience, whether he will have the expertise to compute this amount or not. All of these things should have been assessed by the management only. Auditor now needs to check whether management did this assessment in a proper manner or not. Because if an incompetent person is picked up for computing this amount, then there are greater chances that this amount will be computed incorrectly. Yes. So the first procedure on the part of the auditor will be to check the competency, to check the competence of the expert who has been engaged. And on this management expert who has been hired, as I told you, there's a separate auditing standard which deals with this. Next, this expert will be using some data, because if he has to compute the amount of this gratuity liability, that will be based on data to be provided by the company to the actuary. Data provided by the company. Now this data which is provided by the company to the actuary, this needs to be checked by the auditor, because it's all about GIGO. It means garbage in, garbage out. Means if the data which is provided to the actuary is incorrect, then automatically the valuation that the actuary will do will also be incorrect. So that's why who will ensure that the data to go to the actuary goes, that the correct data goes to the actuary? It's the management. And auditor also needs to check whether the correct data was provided to the actuary or not. So what can the data include? Number of employees, age bracket, yeah, attrition rate, then mortality rate, then we can say increment percentage. Yeah, there's so much information which an actuary will need to assess for the purposes of valuation. So some of this information would be provided by the company, and some of this information may be assessed by the actuary on his own. And in terms of this valuation, actuary needs to compute the present value. And for the purposes of computation of present value, what would the actuary need? A discount rate. So that means along with the data which is provided by the company, there are certain assumptions, or you can say the basis, which will be followed by the actuary, which will be used by the actuary. And that's why it becomes important for the auditor to ensure that all of these assumptions are in line with what should have been used. The discount rate, which would be used by the actuary for the purposes of this valuation, whether that is in line with what the industry has been following. If that is all right, then it's okay. Yeah. If that is not picked up accurately, then automatically, once again, where are we leading to? We are leading to a situation wherein because of this information, or because of this wrong assumption, or because of any of the mistakes in any of these data, the valuation will go wrong. Clear? Yeah. Now, how will the auditor verify this? Again, same thing. Auditor will verify all of these data on the basis of the data which is received from the management, most of the times on a sample basis. So this data, number of employees, age bucket, and the age bracket, attrition rate, mortality rate, the increment percentages, all of these are what? These are all information of the company. These are all historical information of the company. And there will be a trend analysis which the auditor can check and make sure that all of this information is in line with the trend analysis or not. So if all of this is in line with the trend analysis, it's absolutely fine. It should not happen, for example, that the increment percentage of the company is within the range of 5 to 7%. Okay. But when this data is given to the actuary, company is showing an increment percentage of, let's suppose, 10 to 15%. Now, this is a mismatch. This is inconsistent with the actual information of the company. And this is something which the auditor will have to check. Auditor will have to ensure. Because any of these factors, any of these assumptions will lead to incorrect valuation of the actuarial amount. Yeah. Secondly, auditor at times may not be competent enough. Yeah, because at one place, auditor wants to check whether the expert is competent to do this exercise or not. And that checking he is also assessing from the perspective of the assessment of the management. At times, auditor may also not be an expert to test all of these areas. Wherein, what can the auditor do? Auditor can bring in his own expert who will have the skill set, who will have the experience similar to what this expert should have had, and who will then engage with the auditor, who will then be part of the audit team in terms of performing all of these audit procedures like we discussed. And it's not necessary that when this expert will come, he will be performing each and every audit procedure. No, he may be doing only part of the work. It's dependent on the procedures, the planning which the audit team would have thought about. And it's not necessary that they will be doing each and everything. All right, clear? Now, as regards this auditor's expert and as regards this management expert, I'm not getting into too much detail because on this we have separate auditing standards to deal with. But as around some of these areas which are audited by the auditor, it's absolutely important on the part of the auditor to plan the work and to ensure the places where any of this expert will be required, where any of these experts will be required to be engaged. Because any of this expert which the auditor plans to engage could be internal or external to him. Internal means somebody who is part of the audit firm itself, means who is employed with the audit. But at times, auditor may want to engage an expert who is not part of the audit firm, who may be required to be hired from outside. Therein, auditor will require consent of the management. And this is something which will form part of engagement letter of the auditor in most of the cases, because this is something which the auditor would have analyzed on the basis of his preliminary discussions with the management before picking up the audit also. Because without the consent of the management, auditor will not be able to bring in any of the expert which is outside the organization of the auditor. Clear? Yeah. Now, in relation to these areas which are in the nature of estimates, which are subject to fluctuations or which are not really understood with 100% accuracy, we understood that all of these procedures are required to be performed. Let's suppose if there are any misstatements, or let's suppose if there are any doubts or questions, then the auditor can also engage with the management expert. So if the auditor wants to engage, means if the auditor wants to communicate with the or with the management expert, auditor can do that. Similarly, if the auditor's expert wants to communicate with the management expert, auditor can do that, or the auditor's expert can do that. So it's not that every time all of this checking, all of these things will be happening with the management only. No. Auditor can plan to have discussions, communications with the management expert, because by doing this, what will happen? Auditor will be getting better clarity around the work of the expert and will be able to understand the working or the computations, etc., which the expert would have done in a better manner. Yeah, so it's again not something which is necessary to be routed through the auditor or to be routed through the management always. Okay. Yeah. In terms of this expert, another area which becomes important on the part of the auditor will be to check the independence. Correct? And similarly for this expert also, another very important area will be to check that it should be bias free. Yeah, so all of those perspectives around any of these experts which are engaged by the auditor, it's very, very important to assess those requirements. Clear? Yeah. Okay, then I have this query from Jay. Okay, this is on materiality. I'll come to this. Any of your questions around this accounting estimates audit which we have discussed, though we have not been able to complete this, and considering the time, I'll not really want to go further on this. If you have any questions, any doubts on this, please let me know. I'll just touch upon one point related to this, that because this is a very, very risky area in the financial statement, so that's why whenever the files of the auditors get picked up for reviews, files of the auditors get picked up for reviews. Say, for example, it's about peer review. It's a review by, let's suppose, QRB, or let's suppose it's a review by any other authority. Therein, the focus of the reviewers would be significantly on these areas. Some of the large firms, they have practices of getting their reviews internally, independent reviews. Therein again, these are the areas which are of significant focus. Yeah, so that's why this area anyways is considered to be of extreme importance. Clear? Yeah. So if you have any questions, any doubts, you may let me know. And before I end my discussion, I'll just quickly get on to the query of Jay. Jay is saying about this 80% of the materiality as to what's the understanding around it. So Jay, it's about a pool which is reserved. So you can say that any misstatement which goes beyond materiality needs to be corrected in the financial statements, otherwise it needs to be reported. Correct? Let's suppose materiality level is 100. We understand that if there will be any misstatement which will cross 100, that will lead to financial statements getting misstated materially. But at the same time, we also know that because of inherent limitations of the audit, financial statements will have some errors which will go undetected. That's why we reserve some portion of this materiality towards those errors. Okay, and because of which we cut down the materiality threshold by some percentage. Let's suppose say by 20%. That is dependent on the judgment of the auditor. This threshold or this revised threshold, which is lower than the materiality, is called as performance materiality. Yeah. And therefore, if anything which crosses performance materiality could be a problem area for the auditor. Jay is then asking about the trend analysis. Trend analysis very simply means looking at the trends as to how the trends have been moving. So, for example, sales over the years have been increasing by 8 to 10%. And in the current year, we see a decrease of 5%. So that is looking at the past trends as to why this change in the trend has been happening. So this is all about trend analysis. And this trend analysis also varies on item to item basis. All right, clear on this?
Achal, we can tell them that they need to revise it because these are very important topic and it carries lots of weightage in paper. And these are also covered not only in chapter 1, but also covered in chapter 2 as well.
I'm
so
sure
they need to carefully study and we can ask question also.
Yeah, definitely. And Karuna, if you can also help on this query. So this came from Harshad. So Harshad wants to understand, can we refer to new course material for studying old course audit subject, or are there any major changes because latest edition that is available for audit old course on the website of January 2017 edition? So please help out on this matter.
Yeah, certainly. In fact, we have hosted some chapters also on website, except for few chapters like audited under CIS environment. Then our because in new material now we are covering insurance company, life insurance company also. Further, audit of bank is in new syllabus segregated to intermediate also. So only few part of audit of banking is covered at final new. So for bank audit and CIS environment, they need to refer their old syllabus material only. But for rest of the chapters, we have already hosted on website, and those chapters are based on new study material only. So they can refer that. They need to ignore that forensic audit part. They need to ignore quality review part, audit of life insurance, and special aspect of automated environment and audit of bank chapter. Rest of the chapters are almost same. That's why I told ki this course is as well as important for old and new both, because almost syllabus is same. So they can old students also, old syllabus students can also attend this live virtual class, and new also.
And this other query is around their doubts. So if they have any doubts, I think other than this class, where do they reach out? If there is any email ID, etc., you can just share.
They can reach out to us on auditing-final@ICAI.in. In case if there are any queries unresolved, or if they have any doubt about scheme or chapters or applicability, they can come back to us on auditing-final@ICAI.in.
Sure. So I think this would be really helpful for all the students, and thanks Karuna for this, and thanks to all of you once again for your time. So we'll meet next, but before that, please come with the revision of this particular auditing standard. Not only because this is important, but because we'll also plan to have some discussions around the questions on this. Thanks so much.